The global tech scene is currently caught up in a relentless battle that's making waves far and wide. We're talking about the U.S. China chip war, of course. This dispute, which has been simmering beneath the surface for quite some time, has now burst onto the main stage, casting a significant shadow over the world of technology. At its heart, this conflict revolves around one thing: access to advanced semiconductor technology, something that's nothing short of the linchpin in today's modern tech landscape. But why should you care about this chip war? Well, whether you're a tech enthusiast or just someone who loves their gadgets, understanding its importance is key because the consequences of this clash go well beyond diplomatic maneuvers. As we dive into the impact of the U.S. China chip war, it becomes evident that some of the industry's biggest heavyweights have found themselves right in the crosshairs. Companies that have long dominated the tech arena are now grappling with the fallout. Think disrupted supply chains, export restrictions, and geopolitical tensions. Giants like Apple, Intel, Nvidia, and Qualcomm, once thought to be untouchable, are navigating through this uncertain terrain, trying to hold onto their positions amidst all this chaos. So welcome to Profit Protection, where we talk about all the topics important for investing, like technology and geopolitics. So if you like what you're seeing so far, hit the subscribe button for more videos like this in the future. Now let's rewind the clock a bit and get into the backstory of this U.S. China chip war. It's not something that just happened overnight, it's the result of years of economic and political competition between two global superpowers. China's meteoric rise on the economic and tech fronts posed a real challenge to the US, which had been comfortably sitting atop various industries, including tech. China didn't hold back when it came to setting some pretty ambitious goals. President Xi Jinping laid out a vision for a world-class Chinese military and advanced dual-use technologies. The United States started getting increasingly worried about China's use of semiconductor tech in its military. They were concerned about potential national security risks. This unease led to export restrictions on semiconductor-related tech to Chinese companies like Huawei in 2019. And the COVID-19 pandemic played a big role here too. It exposed vulnerabilities in global supply chains, especially in the semiconductor industry. This in turn cranked up the tension between the US and China. Then Taiwan emerged as a major player in all of this. It turned out that both the US and China were heavily reliant on Taiwan for crucial technology, more specifically semiconductors. Furthermore, the stock market's response to developments in the chip war has been dynamic, with major tech companies experiencing notable stock price fluctuations. Let's dive into case studies of some of these companies and explore investor sentiment and reactions in the financial markets. So last month, the Wall Street Journal reported that China instructed some of its central government regulatory officials to refrain from using Apple's iPhones for official tasks. Following this, Bloomberg stated that China intends to extend this restriction to additional state-supported organizations and enterprises. Apple's share value has decreased by 3.3% in one day, adding to the decline of a roughly 7% drop over 2 days, marking the steepest two-day decline since November of 2022. China accounts for roughly 20% of Apple's total sales, making it one of the company's most significant markets. The extent to which China might further restrict iPhone usage outside of governmental entities remains uncertain, especially considering the vast number of Chinese employees involved in iPhone production within the nation. Apple, heavily reliant on semiconductors for all of its products, has seen its stock price fluctuate in response to supply chain disruptions. As chip shortages hit the tech giant, concerns arose about production delays and product availability. Then Nvidia, known for its GPUs used in gaming, AI, and data centers, relies heavily on semiconductors for GPU production. Disruptions in the semiconductor supply chain raised concerns about product availability and the development of AI technologies. Jensen Huang, the chief executive of Nvidia, said the restrictions risked causing enormous damage to the tech industry. In the 12 months to February, Nvidia's revenues from China and Hong Kong declined by nearly 20% year-on-year. And in recent months, Nvidia has started offering a less advanced chip, the A800, to Chinese buyers. But the new curbs being mulled by Washington would restrict even those products. This may have a severe effect on the company's revenue. And our third case study, AMD, The only company within a light year of Nvidia when it comes to production of high-powered chips for AI models is also exposed when it comes to the chip war. Both Nvidia and AMD rely heavily on TSMC for their chip-making capabilities, and while few are saying this out loud in the middle of a trade war, reliance on a key Taiwanese player could soon be distinctly disadvantageous. AMD has determined that it needs to find other sources from which to keep the chips flowing in case the US China chip war goes from cold to hot in a hurry. AMD is trying to hedge its bets, suggesting it may stick with TSMC but try to utilize some of its non-Taiwanese plans. Alternatively, it could switch to alternatives like South Korea's Samsung, but shifting itself outside a long-standing and highly profitable relationship with Taiwan's leading cutting-edge supplier feels like a move that comes with multiple inherent pain points. Moreover, this chip war has brought to light several less discussed consequences that extend beyond immediate supply shortages. One notable aspect is the ripple effect throughout the tech industry. While the focus remains on major players, smaller companies down the supply chain also grapple with the repercussions. As larger corporations secure chip supplies, smaller businesses face increased competition for the limited available resources, potentially stalling their growth and innovation. Additionally, the chip war has exposed vulnerabilities in the globalized nature of tech manufacturing. Many tech companies rely on intricate international supply chains, and disruptions have highlighted the fragility of these systems. To counteract this, some companies are considering reshoring or diversifying their supply chains, a process that comes with its own set of challenges and costs. Long-term effects on innovation and competitiveness are another concern. The chip war could lead to a fragmented tech landscape with regional blocs developing their own semiconductor ecosystems. While this might foster innovation within these regions, it could also limit global collaboration and hinder the cross-pollination of ideas that has driven tech advancements in the past. Furthermore, the focus on chip production and security may divert resources and attention from other critical tech areas like renewable energy, artificial intelligence, and quantum computing. The competition for semiconductor supremacy risks overshadowing collaborative efforts to address global challenges through technology. The future of tech stocks amidst the ongoing US China chip war is like trying to predict the weather on a constantly changing climate. There are several possible scenarios, and it's a bit of a wild ride. First off, the chip war could drag on, causing more supply chain disruptions in the semiconductor world. Tech companies which rely heavily on these chips might struggle to get enough, leading to delays in production and shortages of products that could put downward pressure on their stock prices. On the flip side, diplomatic and political developments could occur, leading to a cooling of tensions and fewer trade restrictions. If that happens, tech firms dependent on semiconductor imports could breathe easier and their stock prices might benefit. Another interesting twist is that the chip war could actually drive innovation in the tech industry. Companies might decide to invest more in research and development, explore new ways to secure their chip supplies, and even work on producing their own semiconductors. This strategic shift could set some tech stocks up for long-term growth. But here's the catch: the tech stock market is going to stay on its toes. Supply chain challenges are like a roller coaster ride, with periodic ups and downs depending on what's happening in the chip war. So investors need to keep their eyes open and be ready to adjust their strategies as the situation evolves. You might feel like the world is crumbling around you, but when you take a look at things, the amount of resources and available information there is to help you maneuver these uncertain times allows you some breathing space. Even the companies leading the charge have to innovate, so there's a good chance that semiconductor chips may offer more options than obstacles, as people tend to find solutions when they most need it. If you like what you see, then consider hitting that like button to show your support and subscribing to the channel to stay up to date on all things related to the economy, geopolitics, and technology. Here at Profit Protection, we do our best to give you the deep dive into topics you may have a fleeting interest in. And if you want to learn more about tech stocks, then you'll love this video of ours where Nvidia's Jensen Huang claims that the chip wars could crush US tech. As for now, that's all we have in store for you today. We hope you enjoy the video, and until next time, take care, and we'll see you then.